Hey, happy Thursday morning to you. I hope your morning's starting off well, depending on where you're at. If you're hunkered down at home, following the guidelines, if you're an essential employee or service, still out keeping us going, whatever it is you're doing, wherever it is you are, I hope it is a great day for you. Before I get started, also, just a reminder, I am giving away my book, Desolate Places. If you will go out to Amazon.com and simply find that book. In fact, I'm going to put a link in here for you as well, and that way you can pick it up absolutely free, and hopefully you'll find that encouraging. Topic for today is kind of near and dear to me. So for those of you who are not aware, long before I went into marketing, I was a financial advisor. Had my own firm for about 12 years. I don't do that anymore. So let me just preface this video with this disclaimer. I am no longer a financial advisor. I am not an accountant, and I am not an attorney. Please do not take this as professional advice for your situation. What we're going to talk about today is good financial literacy and common sense. So hopefully you will take that to heart. The question was posed to me, or thrown out there, by my friend Lawrence. LT and I have been business associates, goodness, for probably 11 years now. And his comment in my thread the other day was people who are pulling their retirement savings and taking it to cash. And this is a great topic. So when it comes to investments, people tend to operate out of three modes, and none of them are good. They operate out of fear, hope, and greed. They're all emotion driven. They're not logical. They're not practical. They are a response to feelings. And so what happens is people will make what I call knee-jerk reactions out of fear or out of uncertainty, without really thinking through those decisions. So let me give you a really difficult case that hits close to home. My father retired at age 67, and he had worked for Bank of America, ultimately was who he finished with, but he'd worked for the same company for basically 37 years roughly. And so what ended up happening, he was agitated, didn't want the bank to have his retirement savings anymore. And so when he retired, he took everything out as cash, which ended up costing him dearly. He ended up paying the additional income tax because it was counted to him as current income in the year. He paid tax on the growth of that retirement savings account. It was horrendous. Created a huge catastrophe for himself, simply because he was making an emotional decision and without understanding all of the financial ramifications of doing that. So let's talk about this whole process. So money in retirement savings, if that's a 401k, for example, that money has been withheld pre-tax, meaning you're getting a tax benefit on that money in that it's not counted towards your current income when you file your taxes. It is a tax-protected contribution every year. The trade-off on that is those monies are allowed to grow tax-deferred, and you're not required to take them out until you reach 70 and a half. And the earliest you can take them out without a penalty is 59 and a half. And so that's the agreement you're making in exchange for that upfront tax deduction. If you've been contributing to a SEP or a traditional IRA of any kind, same thing. You're getting to make that contribution every year. You're getting to pull that away from your current income. It lowers your tax bill. The understanding, however, being that when you turn 70 and a half, you have to start pulling money out. The earliest you can pull it out is 59 and a half. And the understanding is you're going to pay taxes on that growth. At some point, the tax man wants to get a hold of that growth. So many years ago, the Roth IRA came into existence. The Roth is treated a little differently, but same kind of a principle here. So in a Roth, you contribute your contribution. It doesn't come off your taxes. It's after tax money. But what happens in that Roth is that money's allowed to grow tax-free as long as you don't touch it for at least 5 years. And again, you have to be over 59 and a half or, when you start taking your distributions. But the beauty of it is the growth on it is not taxed as long as you've held it for that length of time. So here's what happens. When people start pulling money out of those accounts, typically they're pulling it before they're 59 and a half. And what they end up doing is not only do they incur the cost of, let's say it's in a mutual fund, selling out the position, now they're going to incur the penalty for premature withdrawal, and now they're going to pay taxes on the money that's distributed, and it's going to get tacked on top of the current income that they're receiving. Now, where this gets even more complicated this year is right now, obviously, everybody's waiting for their check from the government. Well, that is also going to be put on top of whatever income you've earned this year. So you are raising your tax bill. It's really not a pretty situation. So here's the thing you need to consider, okay? If you are in this for the long term, meaning you've got time on your side, then there's no reason to make the panic decision. If you feel like you need to go to cash within an IRA, within a 401k, you normally will have a money market or some type of cash account that you could easily adjust to, but keep those monies inside that protected, tax-deferred, or tax-free environment. Where you run into trouble is when you start pulling money out of that environment. So here's the principle you really want to look at is, number one, some things you want to be concerned with, even in cash right now. The Federal Reserve is printing trillions upon trillions upon trillions of dollars to deal with this crisis. The bailout itself is multi-trillion dollar. So what happens is, as those dollars get printed, that means there are more dollars in circulation. Ultimately, what happens is the buying power of each dollar is less, and what you begin to create is an inflationary process. And so here's the thing. Why would you want to pull out and put into something that's losing value on a daily basis because the marketplace is getting flooded with it? So what's really important is that you think about where you are holding your wealth. What may be happening is you may be finding you're very susceptible because all of your wealth is in the markets. It's in mutual funds. It's in those types of things. There are many other asset classes that you could be diversifying into that might help you better hold on to that wealth. So anyway, few thoughts for you. If you've got questions, hit me up. Again, I'm not a financial advisor. I'm not an attorney. I'm not a CPA. And this is not meant to be financial or legal advice for you. So be sure and treat it as what it is. It's one man's opinion of what might be a smart thing for you to be considering these days. Have a great day. Talk to you later. Pick up the free book, and I'll be making a few more videos later today.